The Intelligent Investor by Benjamin Graham, a book regarded by Warren Buffett as the best book about investing ever written. What in the world could be in this book that would make Warren Buffett say something like that? Additionally, he said the two most important chapters were chapters 8 and chapter 20, so I'll go over those first and then add the parts that I thought were important afterwards. But before we get to that, it's worth mentioning that Benjamin Graham was saying things that were totally contrarian to the general public's perception towards investing. It's important to remember that this book was written in 1949, which was just about 20 years after the Great Depression, and it was seen at a time when stocks were seen as speculative and gambling, over bonds were the trusty, reliable, and preferred method of investing at the time, and those were seen as acceptable. And that's when Benjamin Graham came in and told the whole world that their views towards investing was wrong. We'll start with Chapter 8's main takeaway to begin this summary. You see, this man was saying some truly radical things. He said that investment returns were not based on luck, and that they were not based on how intelligent you were as a person. What he was saying was that your returns were based on how much you bought a company for relative to its true value. The price relative to value? Yeah, this is one of the things that made Benjamin Graham so famous, and more specifically, it's for Mr. Market. Mr. Market is an abstract force, but we'll personify him for simplicity. Imagine a person coming to your house every single day and yelling an offer for you to buy your house. Non-stop, every day he'll come outside and yell a new price. He's the most persistent and peculiar salesman in the whole entire world. And if you love your house and don't intend on selling it anytime soon, also pretty annoying. But what does this have anything to do with stocks? Well, with Mr. Market, he isn't looking to buy your house. Instead, he's looking to buy your company, the one that you previously invested in or are thinking about buying. Mr. Market is a personification of the stock market as a whole, and people are throwing out all the prices that they are willing to buy a company for. And it seems ridiculous for our home, but we're used to this behavior when talking about stocks. But Benjamin Graham said this annoying guy can be of use to us. Sure, he's annoying, but it gives good opportunities to buy and sell the stocks we want. All that Mr. Market is giving us is a chance to buy or sell at a given stock price being listed. But that doesn't mean we have to buy or sell anything. We can go at our own pace. And because of that, it's like never being forced to swing at any pitch in baseball. We can have an infinite number of pitches and only swing when we feel like it's a good time. The purpose of the book is that we'll find some intrinsic value for our stock and just use Mr. Market as a way to serve us fantastic bargains. By coming to our conclusion on what a stock is worth, we can then compare the price to what's currently being offered by Mr. Market and make a choice on whether or not we want to buy. But when exactly is a good time to buy a stock? Should we buy it a little before it hits our mark? Should we buy it right at our mark? Or should it be bought when it's below the mark? And that's what brings us to what Warren Buffett considers the second most important chapter. Chapter 20 is on the margin of safety. Before relating it back to stocks, let's talk about bridge construction. If you had trucks that you knew weighed 5,000 kilograms, would you really want a bridge that only supports 5,000 kilograms? Of course not. You would want a margin of safety for extra support. There are plenty of trucks that pass every day, so having a reliable bridge to offset any issues is a necessity. So too should our own investment purchases have a margin of safety. Benjamin Graham suggests buying a stock 50% below what you feel the intrinsic value is worth. However, he later mentions that at a maximum, only buying below 66% what you feel a quality company is worth. The riskier the stock, the larger the margin of safety must be for purchases. More stable companies with bright futures and fantastic management can get slightly higher entry targets. If you liked the video so far, subscribe and hit the like button. It helps grow the channel so others can see this as well. Also inside the intelligent investor is the defensive investor versus the enterprising concept. The defensive investor is someone Benjamin Graham hopes that most people would want to be. He felt this way because most people end up making more mistakes by putting too much time looking for finer details with the stocks. Just because you spent more time thinking about stocks doesn't necessarily mean you'll get better returns. In the book, he talks about the key criteria to follow. I'll give his selection criteria for someone looking at stocks here in this video, but I go into much greater detail for all of these criteria in my previous videos that I did on Benjamin Graham's work, which includes the intelligent investor and security analysis. Starting with number 1, the level of diversification in your portfolio. Having between 10 to 30 stocks is considered good for Benjamin Graham. However, it was mentioned in the footnotes that years later, Benjamin Graham was also appreciative of the use of index funds for exposure in certain areas. So for example, if you wanted more exposure into the energy sector, but you didn't know or have enough experience to pick out individual energy companies, perhaps using an ETF or index fund would have been a suitable choice. Number 2, the companies that are chosen for the defensive investor are large. Sales numbers adjusted for inflation would be at least $1 billion a year. The company must manage its money conservatively. What that means, in a less vague way, is that the company must have a current ratio of 200% or 2.0. Current ratio is the current assets divided by current liabilities. A company with a 2.0 current ratio will be very likely to pay off their short-term obligations without many issues. The company must pay dividends for at least 20 years without any missed payments for the defensive investors. For number 5, the company must never have decreasing earnings over the past 10 years. Number 6, additionally, those earnings must grow at least 3% annually during those same 10 years. Our money should be growing with our company as they produce stronger results. And number 7, a cheap price to earnings ratio. This is often relative to the industry, meaning a retail store will have a much different looking PE compared to a software company. But for Benjamin Graham's suggestion, the PE should be below 15 for defensive investors. Number 8, lastly, we want the assets that we're buying to be cheap as well. For this, the assets minus the liabilities times 1.5 should be greater than the market cap of the company. So what about our enterprising counterpart? Well, things look roughly similar. Looking at our defensive checklist, let's see which ones are the same and which ones are slightly different. For diversification, it'll get changed to some diversification. The interpretation of that is left to the enterprising investor to decide. For sales minimums, there are no minimums. Enterprising investors can see companies that are very small. As for the conservative financing, this ratio will get knocked down to at least 1.5 instead of 2.0 for our current ratio. For dividends, they must be paying at least this year for the enterprising investor suggestion, as compared to the 20 years for the defensive one. With enterprising investors, there shouldn't be any drops in earnings only in the past 5 years. For growth, the past 5 years must be positive improvements, but not the minimum of 3% like our defensive counterpart. As for PE, the enterprising investor should come to a conclusion as to what cheap means relative to the industry and the quality of the stock itself. As such, there is no set number for the enterprising investor. And lastly, for cheap assets, the tangible assets minus liabilities times 1.2 must be greater than the current market cap. Here's a side-by-side comparison between the guidelines given by Benjamin Graham between the defensive and enterprising investors. Feel free to pause the video here and look at the differences once again. Is the enterprising list better than the defensive list? Or is it the other way around? For Benjamin Graham, He'd prefer if most investors stick to the defensive style since they likely don't have the experience nor the time to truly utilize the loosened guidelines. However, if you feel you have the time and the knowledge in the industry, it might be worth looking at a wider lens with the enterprising guidelines instead. All topics included in the book are the ones listed here. Feel free to pause the video and see what other topics this book has to offer. Wondering if The Intelligent Investor is a book you should read? Check out the video titled "Should You Read The Intelligent Investor" for a nice overview if this book is a good choice for you. For those who are inclined to read it, you might wonder how long this will take to read. It'll be around 10 hours from start to finish, but a fantastic 10 hours for those who are interested. What book would you like to see me do next? Leave a comment on what you would like to see in the future. If you enjoyed the video all the way to the end, subscribe and hit the bell to stay up to date on future videos. And if you could hit the like button so that others could see the video as well, that would be greatly appreciated. Thanks so much for watching, and I hope to see you in the next episode.